Hello, everyone, and welcome to BFW 2401 week 5, which is bank capital planning. Now, today we will talk about the capital or bank capital from the perspective of the management. And chapter 11, or in week 11, we will talk about bank capital from the perspective of the regulators. Now, I have chosen to divide today's recording or lecture into two parts. The first part, we will talk about the definition of capital. And when we define the capital in banks, it's a little bit different in terms of the structure it's different from when we talk about capital in corporates. This is one issue. The other issue, we want to measure it. We have different measures of capital. And the third thing, we want to talk about the core of this part, which is part one, which is the target capital. Because when we decide on the capital and when we measure it, we want to know whether it's enough or not enough. We have to come to another issue called target capital, which means how much capital actually we need that serves or maximizes the shareholders' wealth. Once we decide that, this will be in the first part. When we go to the second part, which is a continuation, we will decide on how we raise that capital. Are we going to take it from external sources, like the return earning that generated by the net income of the company, of the bank, or are we going to get it from external sources? And external sources means we need to issue new capital, which is issuing actually new shares. Now, when we say issue a new capital, usually we issue equities. And later on, we will talk about the modeling, which will help us decide how we raise that capital and how much we need, whether the internal sources is not enough or the external sources are enough. Now, before we go to those details, I will go over it one by one. This is just the story of the whole issue of bank capital planning. Now, if you allow me, let me share and we can start those one by one. Now, this is actually part one, and we are talking about, this is just the title of this lecture of today. And then we go to here, which is, we have seen it here. We have seen this slide before many times. And we are actually trying to, I'm trying to map your thinking around this issue. So today we are talking about this week, which is week 5, which is capital planning. Now, if you remember, we already talked, this is the whole picture of the whole unit that reflects the objectives of this unit. So the learning objectives of this unit. So we have finished in week 1, the financial institution specialness. Then we moved in week 2 and talked about defining bank risk. Specifically, we talked about the interest rate risk in terms of management and measurement. And then in week 3, as you remember, we talked about securitization and loan sales as one of the tools to manage interest rate risk. And then week 4, we talked about what we call analysis of bank performance. Today, we jump to capital planning in this journey of knowing bank risk. Now, having said that, you already know where we are moving and in which part we are in the unit. Let's go to the learning objectives of learning bank capital or planning bank capital. So we want to discuss the different approaches to define capital and measuring banks' capital position. Number two, we want to outline the bank capital planning process. There is a process which starts with actually with selecting something called the target capital. And then we need to know how we achieve that target. Then, as I told you later on, we will talk about two models where we have some calculation. These two models called internal or organic capital and external sources for tier one bank capital. And finally, we will go to come something to one thing called a model called asset growth model. Now, asset growth model will help us in projecting bank's future capital position based on its access to internal capital, which means how much internal capital is providing and securing that target capital. And we will see how much we need to get from the external sources, which means we forecast the internal sources and the external sources, and this is has some calculations. Now, having said that, let's go to part one. As I said, this is the references. This actually chapter, I already summarized it, and then and these slides, I think the slides are enough. Most of you have not don't have access to this book, but I actually have made enough arrangements here and also in the tutorial and in the workshop that we will have to make the resources that I provide you to understand bank planning enough. So we have the slides, and later on we will have the tutorial and the workshop. Now, this is, as I told you, part one, and we will start with, actually, we are trying to cover those three issues in part one, which is the blue font, which is the definition, measurement, and selecting target capital. Again, to tell you that selecting target capital or a capital target is the most, the core of this part, which needs some modeling. Now, define the capital. The capital, as we know it, it's equity capital definition. This is the normal definition. We see it in a business form, which is it's the net worth of the enterprise, total assets minus total liabilities, which is the difference between the bank value assets and the bank value of liabilities. And this is very well known to most of you from a basic accounting class. Now, the main components of this capital will be the issued shares and any return earning over that, of course. And then we have the reserve, and we have, the issued shares, the retained profits, and any reserves. So this is the main three items, actually. Now, why we need capital in the bank? What is actually the purpose? What does it serve? We already talked many times to have it as a buffer against unexpected losses. And this is the main, actually, objective of having capital in a bank. But also, we, according to the literature, we use it as a source of long-term funding. And this is just for the functionality of capital, but also it demonstrates the shareholders' commitment. When we say demonstrates shareholder commitment, when a bank have enough capital and participating in its long-term loans and assets, this actually will perceived by the investors and shows shareholder commitment and absorbing any losses in the future for their operations. Now, it supports the market confidence, especially among investors and depositors. When they see that the bank has enough capital, they know it's able to absorb losses before that losses touch their money. So if you have a bank with 1% or 2% capital and 98% of it is debt, they know that this bank is very, very sensitive for any expected losses. which means there is a possibility or probability that any losses that exceed the 2% that they keep will move beyond that and consume their deposits or their investments. Now, this we have talked about it many times also, but this is the process of actually of defining capital from the perspective of its functionality. So as we are working in banks, we have inherent risk. And when we say inherent risk, we have all these list of risks. We already talked about it so many times around the matrix of 10 different risks. Now, as we operate in banking, we are going to be exposed to those risks, whether we accept or don't accept. Now, but actually we will have management systems and control to deal with those risks and mitigate their impact on the bank. So we will have, for example, liquidity measures and liquidity levels in the bank that allows us to absorb any liquidity risk if there is unexpected withdrawals. So we have enough liquidity in the bank as cash or other assets that be converted to cash easily. So in this case, we have, for example, if we talk about liquidity, if we talk about credit risk, we will have enough. First, we have to have a good management system of choosing and controlling credit risk from the selection of the borrower to the contracts, term of contracts, we did it with the borrower, and from maintaining those contracts. All of those are actually coming through management and control of credit risk, for example. We also will have some type of reserves or provisions for bad debt if some of those borrowers default. And then after all of this, after we absorb all of those losses, hopefully all the losses will die here and not move. But if they happen, if it happens and the losses were too much, because unexpected losses too much, they will move to the capital, and hopefully this capital will be enough. Now, in this class or today, we want to see how much this capital. Now, the regulators will tell you 10.5 cut, and every single bank have to wear that shirt, which means they have to have that free size shirt. Everybody will wear it, and he has to have 10.5. But from the management perspective, if I am riskier, I need more than 10.5. Maybe I need 12% or 13%. Some may need 20. So it depends actually on the level of the risk and the buffer they are willing to have for the sustainability and the continuation of the bank. So, so the process is we have risk, and you have against a given system of management and control, which is this part. And then they have to have more capital, means lower probability of insolvency and have a safer bank, i.e. less capital risk. So if you have enough capital here, then you will have to have a less capital risk. But that more capital, the question is how much? It should be a target capital, because too much capital may impact the efficiency of the bank. Now, how do we define capital? We have the first definition, which is the equity definition, which we already know it. And the second definition, we will call it coming from the regulation or the regulator's perspective, which we call it regulatory definition. Now, the essential characteristics of bank capital is to provide permanent and unrestricted commitment of funds. And I want you to understand those points very well, because in the next two slides, we will start to break down bank capital to something called good quality capital, which is tier 1, and less quality capital called tier 2. So the characteristics of bank capital is to provide a permanent and unrestricted commitment of funds, which means that capital has no servicing fee. it is belong to the shareholders, and the shareholders will receive dividends only if there is dividends. But they will receive, but they have minimal claim, or they have their claim is a residual claim, what we call it. Residual claim means they will receive only their funds after we clear all the debtors, all the creditors, and all the shareholders, all the creditors. So those are the shareholders. So after we finish all those people whom we owe, now whatever left, which we call the residual funds here, it will serve to satisfy the residual claims of the shareholders. Now, it should be freely available to absorb losses, which means you can use it. There is no problem of using it. It's not depositors' money, it's shareholders. And if there is losses, you can absorb those losses through this capital on the expense of the shareholders. Now, it doesn't impose any unavoidable servicing charges against earnings. Now, sometimes we take debt that can be converted to capital, and we can accept it as capital, but actually capital has no unavoidable. It can be avoidable, which means I can give a debt, issue a debt, but that debt, according to the agreement, can be transformed to equity, which means if I decide as a bank. So you can do that. But when we say impose any unavoidable, which means now it becomes a debt. If it is a debt that is like bonds or any borrowing that have to be paid for interest, then in this case, it's not a capital. And finally, we know this is the residual claim, which I told you about, which is capital should rank behind the claims of depositors and other creditors in the event of liquidation or winding up. So this is what we are saying about this issue. Now, let's come to the tier 1 and tier 2. Now, tier 1 definition is actually those 5 items, 1, 2, 3, 4, 5 items. Now, those 5 items, one is the ordinary shares, which means this just the normal issues of stock of company shares. And number 2, we can have what we call preference shares, because we have ordinary shares, but also we have what we call preference shares. When we talk about preference shares, we talk about non-cumulative preference shares. Now, let me tell you, I think you have studied the preference shares before, but if the preference shares are not cumulative, means if I'm giving the shareholder, the holder of the preference share 6% as dividends, and this is fixed dividends. Now, sometimes the management may decide not to pay dividends to anyone, including the ordinary shares. Non-cumulative preference shares will not receive also, but they will accumulate this to the next year, which means if I'm giving 6% and I didn't pay this 6% this year, the next year I have to pay 12%. If I don't pay that next year 12%, I will have to pay 18% in the third year. So it becomes like a debt, which means it make it, this is if it is accumulative. Now, the non-cumulative one is if I don't pay this year, it's over. Next year, we'll start from scratch. So if there is profit and we decide to pay dividends next year, they will receive 6%. So this is why this becomes when we compare between cumulative and non-cumulative preference shares, non-cumulative is better than us as capital because it avoids any unavoidable servicing charges for this type of financing. Now, the retained earning is just something belongs to the, this is the part that is taken from the net income and not distributed as dividends. So the net income part of it will go dividends, and what we retain and keep in the bank called retained earning, and we can use it as capital freely. Now, sometimes we also have general reserves, which we take, by all the time. We keep reserves for, provisions, reserve for bad debt, for non-performing loans. All those type of reserves is actually kept in the side. The bank is not used. It will be used when we need it, but during this time, it is considered part of the Tier 1 capital. Now we have also specially approved hybrid securities. When we say specially approved hybrid securities, those hybrid, as you can see it, hybrid securities are those type of securities that can be converted to equity under the discretion of the bank. So I issue it as a debt, but I convert it to equities, which means now I can avoid any servicing charges. If I want to keep it as a debt, that's fine. But if I need it as a capital, it is considered to be capital. And what do we mean? Which means this debt will have no claims. It'll have only residual claims, exactly like the shareholders, the normal shareholders. And this is why we think we can use this as capital, and it is a quality capital. Now let's look at another type of capital, because bank capital is Tier 1 and Tier 2, and both of them called the total capital. Let's a little bit define what do we mean by Tier 2. Now, Tier 2, we call it supplementary capital, and it has some essential characteristics, not all the characteristics for the good capital. And the first one, and they are, as you can see, another 5 items. One of them is mandatory convertible notes. So mandatory convertible notes is a bond issued by a company. So it looks like a debt, which must be converted into shares to common stock on before a specific date. This is actually like this item, which is the specially approved hybrid securities. It is the same, but actually for some time it will live as a debt. Only before a specific time it can be converted to equities, and this is why it is less quality than the one coming in Tier 1. Now, the asset reevaluation reserves, this line item can be used when we reevaluate our assets and finds that the carrying value of the asset has changed. What do we mean? For example, if I am one of those local banks, say one of those big banks, and they have been operating for 40, 50 years in the country. If they bought a land, or they acquire a land, or say huge buildings, and that was 5 million ringgits in 1970 or 1960, where last century when the prices were low. If this land or this building in a good location, for example, and KL, and they want to sell it today, the historical value is still 5 million ringgit. But if you want to sell it, it can give you up to 300 million ringgit. So if it's a tower or something like this. So in this case, actually, the difference between the price, if you reevaluate it, and when we say reevaluate, you are not selling it. If you reevaluate it, there will be huge profits or gains from this reevaluation. Now, this is a capital. Yes, it belongs to the bank, but you can only liquidate it if you sell the building. Now, if you are using the building, it's very difficult to liquidate or to use it as a capital. And therefore, why we think reevaluation of assets is actually less quality capital than Tier 1. You cannot access it easy as you access Tier 1. Now you have the general reserve for credit losses. So a reserve held against future presently unidentified losses. This is specifically, see here the general ones, what we call the general reserves. But when we talk about the reserves for the credit risk, we have the provisions for credit risk. So, and those ones, for example, we expect say 2% or 3% of our borrowers to default. Now, if they default and there is a possibility that they default, we will use the reserve. So we keep, topping up this reserve or provision from the profit of the company, from the bank, as we move, as it is charged to the operations. It is not defaulting yet. It's not a bad debt yet, but it's a contingent, and there is big probability that it will happen. So if it is happening in the future, then in this case it becomes contingency, which we call it, contingent liabilities. So in this case, if it happens, then in this case we can actually use these losses, use these reserves. Meanwhile, it's still in the bank's books, and you can use it as capital within Tier 2. Now, cumulative preference shares, I already explained about non-cumulative in Tier 1. Here, just the opposite. Non-cumulative, this one, which means there is no charge if you don't pay, but this one you still committed, which means if you don't pay this year, you will pay the next year and the third year. So if it is 6%, you don't pay this year, next percent you pay, next year you pay 12%, and the year after 18%, and so forth, if you keep not paying. So it's actually unavoidable type of servicing charges. Also, it's not paid, but it's still as a liability for the bank. Now we have also the last one, subordinated debt. Now, subordinated debt is any type of loan that paid after all other corporate debt and loans are repaid in the case of borrower default. So actually, it's a debt, but if something happening, in this case, this one is, just to differentiate, this one means it's up to the bank to convert it to equity. This one, the bank will not convert it to equity. It's just when it comes to payments to the creditors, those come at the end, which means now the creditors of the bank are not really worried about this, because it will come, it's not in their rank, and it will come after they have been paid in case of liquidation or winding up the bank. So this is how they preserve bank capital. Now, Tier 1 and Tier 2 is very important for the regulators and also for the bank, and we will discuss those later on. Okay, now Tier 1 capital is the focus of capital planning. It's the most important one. So our regulators, emphasizes this Tier 1 capital, especially the equity capital. It has a huge potential to reduce risk per dollar, and it's longer lead time and more expenses involved in raising this type of capital. So raising this type of capital actually, for example, if you issue new capital, new shares now, or new issue of your stocks, then it will take actually some time for all this process. It's not like when we do in Tier 2. And this is the best capital. This is very similar, it's not the same, to equity capital in corporates. Okay, now those slides from 23 to 20, you can talk from slide 10 to slide 13. I already actually summarize them all here, and you can please look at them. So as you can see here, the capital is here. This is where the capital is. And this is the equity capital definition. This is the regulatory definition. This is the function of capital. And this is when we break it to Tier 1 tier 1 and tier 2. And this is when we talk about the why tier 1 is the focus of capital planning. And this is the function of capital, as I said, and this is the risk. So all of those, actually 6 or 7 slides, you can map your mind and thinking around them here. This is a comprehensive slides. Okay, now we move to the measurement. Measurement, I think it will be easier because you have seen these issues before and these ratios before, and it's very easy to calculate. So we have 4 ratios called gearing ratio, leverage multiplier, and simple capital ratio, and risk-weighted capital ratio. So equity is involved in all those ratios. So liabilities over equity is 1, which we call it the gearing ratio. So equity can be in the numerator or in the denominator of this type of ratios. And it will have, of course, different meanings, but still a measure of capital. So the gearing ratio, liability over equity, the multiplier is total assets over equity capital, the simple capital ratio, which we know all, equity over total assets. And this is one thing new. We will know it later on when we go to week 11, which is the regulators. The regulators will ask us to calculate the capital tier 1 and tier 2. See, now they are using tier 1 and tier 2 over the total risk weight, total risk weight assets, which means the assets that have only risk. So if you want to know, we will know about this, in details in week 11. Now let me look at this. Just one note before we move to the calculation of this capital ratios. Capital is different, and we have talked about it when we talked about performance, because there, if it is measured using the total asset or the total liabilities, if the total asset or total liabilities included in the measurement of the capital, then in this case, the ratios will be actually not easy to compare to group rates. So this message, because the nature of the liabilities and the assets are different. Anyways, these measures of bank capital position will give very different numbers compared to any manufacturing firm or a business firm. The leverage ratio will appear very high and the equity capital will appear very low. This is because of which we talked about, the financial intermediation issue. So their balance sheets include large dollar values of deposits. So this is when we talk about, for example, the gearing ratio here. When you have the liabilities is not, dues to the suppliers, but actually the supplier, the depositors' money. So when you come and compare it to the equity and group rates, here will be the supplier, and banks here will be the depositors. So which is actually different, and this is what this slide are trying to tell us. You cannot compare. Okay, this is the balance sheet, a normal balance sheet for assets and liabilities. And we want to calculate those 4 ratios. We can calculate them. So this is the liabilities over the capital, which we find at 13.3 times to 1. So, or you can say 13.3 times. It's 13.3 times. You can say this if you like. And it's the right thing. So it's consistent with the next one. Or you can say 13.3 times to 1, which is the capital is 1, the liability is 13.3. If we talk about leverage multiplier, it's 1,000 to 70, which is 14.3 times. And then the simple capital ratio, which is 70 over 1,000, which is 7%. This is, we are familiar with this because the capital is coming as the numerator and this is the denominator. So risk-weighted assets, we cannot calculate it because calculating the risk-weighted asset is actually a long process. Now, just to go to the interpretation. So in 1 and 2, if there is an increase in this 1 and 2, means the bank is more leveraged. And when we say more leveraged, it's more risky. So this is what we are saying here. So here we are talking about 13.3. What if it is 20 times? That means this has to be something like 2,400. If you want to have it as 1,400. If you want to have it as 20 times, for example. And therefore, the higher this one, the higher is the capital risk because you will be more leveraged. Same thing, leverage multiplier will be higher. But if the capital is the numerator and this is the denominator, then in this case, decreased in capital will actually decrease the capital risk. So the capital here in number 3 and 4 is actually in the numerator. And this is why it will decrease capital, which means we have more capital here. We have the higher of those ratios, means the less capital we have. Here, the higher those ratios means the more capital we have. Okay, now let's go to selecting capital target, which is the thing that we are looking for. Now, to select something called capital target, we have to select the target level of capital that is, it's a planning objective to do that. Now, to set that target, we have to assume a level of intrinsic risk, which means how much risk we have. Because as I told you, the logic behind capital is to absorb losses. So this approach is reflecting what we are saying. You have to see how much is your risk. And then if you see your risk, you will see how much you can mitigate that risk through those systems. Later on, you will see how much is left. So you have risk minus the controlled. Then the rest is actually the capital that should be there for the unexpected losses that cannot be controlled by the management systems. Now we have, based on that, we have to select an optimal level of capital. And this is very important because it's not that I will take step 1 and go. I still know whether this capital I'm going to take is actually the one that maximizes the shareholders' wealth. And there is a model to tell me that. It's not only depends on one, which means you have risk mitigated by systems, still risk, moving to the capital. So I want to take all that risk and say, oh, this is my capital. So I say no. Now, what we are saying here, even if this is the capital, we will see whether this is the capital that actually maximizes the shareholders' wealth, even if I still take more risk. So we come to a concept called optimal risk return position. Now, the optimal risk return position, they don't take a risk as an absolute number and they say this is our capital. We have to measure that capital against the maximization issue of our shareholders' wealth using what we call the optimal risk return. Let me tell you how this planning is working. Now, to see what are the benefits of having less capital or more capital. So for more given level of total assets, for a given level of total assets, there is a decision to increase equity capital that is equal to a decrease of debt. So if we have a total asset, the structure of those assets, some of them can be capital and some of them can be debt. The question is how much debt and how much capital, assuming there is no regulation, and we are talking now from completely 100% private incentives. Management is managing that. They want to decide in each loan how much I should have capital and how much I should have as debt. So how this decision of saying, okay, we'll have this capital or this capital or this debt or this debt, to decide between the level of debt and level of capital in one loan or in the loan portfolio, then you have to consider three effects. First of all, tax deductions. Because when I take debt, I will pay interest, and that interest will deduct the net income before tax, which means now that I will pay less tax. And this actually will increase my cash flow and increase the value of the bank. This is the good side. The bad side is I will have a capital risk. If I just say, okay, take debt as much as you can and have as less as capital as you can from capital, so by that you can actually increase the value of the shareholders because you will have more cash flow from the savings of the taxes. You can say that. You still can say that. This is a valid argument. But that doesn't, this is only the good news about it. The bad news is if you keep that less capital, then in this case, you will have capital risk. And capital risk means if you cannot really, the capital risk, I will show you what the capital risk in a while, but the capital risk will actually increase the volatility of the earning of the bank, which means when I take more debt, this debt can be, sometimes the cost of this debt can be high, sometimes it can be low. And if I, model this over the years, you will see that high volatility in the earning. And that high volatility of the earning is not good for a company because it increases what we call the standard deviation and make the earning volatile. And when investors see that zigzagging and that volatility in the earning, because the decrease in the fluctuation in the net income, because of the fluctuation of the interest rates of the debt I'm taking, now that is not good. Number three is the market discipline. What do we mean by market discipline? Now, market discipline, I already gave you a hint here. Market discipline is the duty of banks and financial institutions, sovereigns, and other major players in the financial industry to conduct business while, this is the keyword, considering their stakeholders. Who is the stakeholders? And for the bank, the stakeholders is depositors and investors. Now, if these people are not happy and perceive you as risky, if you decrease your capital in this stage, they can watch. And if they can watch, they can increase their cost of capital. So, and they are not going to issue a complaint or do whatever. They just will ask for more return. And by that, they penalize you. Now, all this process is bringing, if you know that you will be penalized, then you will behave better in terms of how much capital you have. This concept called market discipline, which is the market can actually react by penalizing you through what we call market discipline. And then finally, we go to what we call regulatory compliance, which everybody know it. And the compliance is actually the penalties imposed by the regulators. Now, let's now talk about those three items. We will talk about the tax. First, tax. So the tax deduction on interest, deduction on interest on borrowed funds. So a lower level of equity capital means more debt funding. This attracts tax deductions on interest expense and hence reduces after-tax cost and increase after-tax profits. Now, this is a good thing. Therefore, less capital will increase the value of the bank. And more capital will decrease the value of the bank. So what kind of argument is this? If less capital will increase the value of the bank, I will go with that. And so the argument now here, if we are taking this position of tax deductions, now I am going to go with this issue, which is I will argue for less equity as a management. I will argue for less equity. So the argument here for less equity. Now let's go to the next step, which is capital risk. We have 4 items: tax deduction, capital risk, market discipline, and regulatory compliance. I finished capital, this what you call tax deduction. Let's go to capital risk, how that concept works. So a lower level of equity capital means higher risk in 2 ways. What are those 2 ways? A smaller cushion to absorb unexpected losses, which means we have just a little capital to absorb those losses. And this is a minus, actually, when we decide to have less capital. Now, as I told you, it will be more volatile earnings. So more volatile earning, so that volatility in the earning will increase because, as I told you, if I'm financing all my assets from debt, and this debt, some of it short-term, long-term, whatever, the interest rate will keep changing in the market. And so does our interest charges, which means interest paid. So if the interest paid is actually fluctuating, that will make the interest expenses in the income statement change for the same level of debt, change from year to year, because the cost of debt is changing. And therefore, the net income will changing. And as I told you, that will make the earning very volatile and will increase volatility in the earning of the company. That will also be reflected in the share price. So if you come to this argument, which is the capital risk with those 2 issues, are we arguing for less capital? So if we say less capital will reduce. So if it's going to reduce, this, according to this argument, it will reduce the value of the bank. And therefore, more capital, based on this argument, will increase the value of the bank. Now, if this is the situation, which means now this argument is saying what? This argument is saying we argue for more capital. We argue for more capital. Now let's go to the 3rd one, which is the market discipline. Now, in theory, higher capital risk will result in market discipline. This is the term we are looking for now, and we have talked about it just now. Now, a lower level of equity capital means higher risk of insolvency. This is how the investor thinks. So informed investors, which is those institutional investors who have information and can actually have this awareness of what we call of the capital levels inside the bank, they will react and they will ask for higher rate of return on funds lent to the banks. And the bank will face higher cost of borrowing, and therefore their profit will tend to be lower because they are paying more. Now, less capital in this case tend to reduce the value of the bank because your earning will be less, and more capital tend to increase the value of the bank. So the problem, bank debt is supplied by depositors and other investors. And many retail depositors, in terms of this factor, many retail depositors like me and you and other people are unsophisticated, which means their financial awareness is not as institutional investors. And those people are actually the majority of the majority in the liability portfolio of the bank. And therefore, more retail depositors are unsophisticated and cannot assess bank risk. They don't know what does higher level of capital or lower level of capital means. While other investors often believe that there is no risk, a government guarantees bank. And this is actually some impression there. Yes, the government have insurance companies to insure the banks. The government will bail out banks when it is necessary, as they did. But that doesn't mean they guarantee banks. If banks is going to become bankrupt and fall, then it will shut down. They will let it shut down unless it's huge and big and as we say, too big to fail, then the tax money will come and they will start to save this bank. But let's talk about the normal situation. The normal situation, if a bank comes and it goes bankrupt, it goes bankrupt. And we have seen so many banks are going bankrupt and shut down. So in this case, that impression is not right. So retail depositors and others who think the government is actually guaranteeing the who think that, sorry, so that banks are actually guaranteeing government guaranteeing banks. This to impression, which is actually there to some extent. This is why we don't take this factor in the modeling. They don't take the market discipline and the modeling of the target capital. Remember, I'm trying now to model the target capital. So I said, I want less capital. This is the first thing. But the less capital has actually shortfalls. And those, the plus is I will have a tax profit, but the minus things, I will have market discipline, capital risk, and regulatory. Market risk, you can take it out because from this argument, because of the, as I told you, sophistication of the depositors and some other investors. Now let's talk to the regulatory compliance cost. Regulatory compliance requires bank to hold a minimal level of capital, and the bank capital levels fall closer to this minimum. The regulators will increase regulatory supervision and associated compliance cost, which is too much. They can take the bank, they can restructure it, they can prevent you from giving high exposures, loans with high exposures. They will, just mitigate and really interrupt your business as a bank. So less capital tends to reduce the value of the bank, and this argument we are talking about the regulatory regulation perspective. It is what increased the value of the bank is actually more capital, not less capital. So the argument here for more capital. So I summarize it here and this and this. So I take the first one, tax deduction, and then I take the financial risk, bring the arguments of it, and I want you to use this one. And then I take the market discipline, as I told you, and then the regulatory compliance. And this is the argument behind all those issues. So this is the only one that think this, the increase in capital will decrease the value of the bank. The other ones, the value of the banks will drop, the profit will drop, and the value of the bank will drop. And therefore, all of those is arguing for more capital. This is the only one that argues for less capital. So now let's go to the model. Now, selecting an optimum capital ratio, this is, as I told you, the fourth argument, right? So now selecting the optimal capital ratio as the theoretical model, we take to consideration the following: the tax effect and the regulatory compliance, only the two factors. We omit capital risk and market discipline at this effect is minimal for the banks. So just took it as it is. We are talking about the two things. Now, how that will increase or decrease the value of the shareholders. Look, this is the model. The value of the shareholders, the value of the bank with both equity and debt funding, assuming no market discipline and capital risk. So the value of the bank is the basic value plus the debt or the benefit from taking debt. This is the tax benefit actually, which is T times D, minus the compliance cost. So if we take this model and try to put it here, and this is, we have talked about it. This is actually without the compliance. Compliance, which is this one, this line, this linear relationship is only tax benefit. And therefore the argument is what? When we talked about it, we say the argument is, this is an argument for more capital and more debt and less capital, more debt and less capital, which means take debt, take debt, take debt, go as much as you can, because you will have this line all the time. Because you will have this line all the time going like this, as long as you move from here to wherever. So as you can see, the value of the bank now is increasing. The value of the bank is keep increasing. Okay, so coming back to the my status quo, this is what we used to have. So now we come up to the compliance. Now the compliance is the one that is minus, which means here the marginal profit from tax deduction minus the marginal cost of not complying is plus. So keep take debt, keep take debt, because now the marginal profit of because this of taking debt and taking risk is more than the compliance, and they will continue in this line until it started to take this inverse U shape or this quadratic equation, and we will have here to reach the optimum. Now, what we call this process, we call it, as I mentioned before, the optimal. When we talk about the target risk, this is very important actually to come back to here, just to review. This is what we call the optimal risk return position for a bank, is a position which maximizes shareholders' wealth and therefore maximize the value of the bank, which means the marginal benefit of taking more debt is higher than the marginal cost of compliance, which I think has mentioned here. So if I come back to here, now I have given a question in the exam last time, which we're saying this is a theoretical approach, which is the trade-off. I want you to understand what do we mean by trade-off in this stage. So the trade-off is increase debt and reduce the capital ratio so long as the marginal increase, this is the term, marginal increase in shareholders' wealth due to the taxation advantages outweighs the marginal decrease in shareholder wealth from the increase of compliance cost. This is the thing that actually very important to know, which means we are talking about the marginal increase in shareholders' wealth due to the, or you can say, keep it like this. I think this is the best way to know it. It's about the marginal cost and the marginal benefits. So you would choose a target capital ratio which correspond to the maximum possible bank value. How can we operationalize this? Look at this, for example. I brought to, this is also an exam, was an exam question. Look here, if I can come with the data, and the data can draw for me this curve. So I will calculate, I will use a scenario analysis where I will calculate the capital debt combination or structure in each stage and see the marginal profit, the marginal increase in the shareholders' wealth. And I will continue in this curve until I reach to this position. For example, I reach to C. So if this is the debt, which is, I take it here from 0 to 100%. So this is 50% debt. This is 80% debt, which is actually close to the optimum. So in this case, what I will decide in my capital structure to be in my loan structure or financing structure to have, this is 85 debt and 15% capital, which means what is the target capital or the optimum capital in this case? If I ask you, it will be 15%. So this is the whole story. If you look at this, I want you to, because this, as I told you, is very important maybe to know. So actually, this is the debt, 85. Means you decrease it from 100. I should have, if this data that brought this curve to me is correct, then the optimal capital for me is 15%, and I should raise 15% capital. And I will see now, do I have 15% capital from my internal sources, or I have less than that or more than that? If it is more than that, get rid of it. Divide it, distribute it as dividends or whatever. You can distribute it as dividends. If you don't have enough from the internal, then you have to consider to raise something external. So if the internal, for example, guarantee you 9%, 10% increase, give you a capital of 10%, then in this case, you need to have 5% from external sources, which is issuing stocks. Now, in this, we will talk in the second part, but this is at least in this stage, we understand what we mean by target capital, and how can we reach to it, at least theoretically. Okay, now selecting a capital target, setting the target capital ratio is other factors. Oh, this is just another information we have to consider when we select other factors. We have to look at the rating agencies' response, which is banks wish to avoid being downgraded due to a weak capital position compared to their peers. We also need to consider the debt capacity and flexibility. In other words, when we have less capital and we are fully leveraged, which means in any need, we cannot leverage more. And if we cannot leverage more, we will not have any debt capacity after that. So we need to have some room, available if we need actually to issue more debt, and we still have room for our leverage. We cannot, just consume all the leverage possibilities, which means I am taking only 2%, which means a 98 debt. If I am under any stress now and I want to issue debt, I cannot go. That means I will go over 100. I have only these 2% to reach to 100. It's different from when I am 80% debt and 20% capital. I still have that. I can increase it to 15, decrease it to 15%, to 10%, issue debt and increase. So this is what you call debt capacity. You don't want to consume all the room available for future leveraging. Now, future acquisition plans, sometimes we need to make any acquisitions, take over banks, do all those things. Now, when we take over banks or merge, there will be a new consolidated statements, and this new consolidated statements, if we are highly leveraged and the other one is highly leveraged or more than us, then in this case, maybe we exceed the leverage levels, and we will be, perceived as a very leveraged new bank, consolidated bank, which is actually risky and sometimes may not be accepted by the regulators. We have corporate control. Corporate control is an interesting case, and what you call in corporate finance. Sometimes the managers will come and will decide to have more and more debt, not from the perspective of the risk, but from the perspective of taking control. So they want, end of the day, to take control over the bank with the creditors. So the creditors of the bank and the management, finally, if they own, if the creditors own 90%, 95, 97%, then they will direct the bank with the management, and the shareholders will be a minority. So this is another issue whether to consider, whether you want to actually to leverage more or less. Now, availability of cost and funds. Now, sometimes if your share price is high, maybe this is the best time to increase your capital. And sometimes if the debt is very, very cheap in the market, so maybe this is the best time to borrow from the market and increase your leverage. So this is issues which we call availability and cost of funds. If the bank share price is high, it's more attractive to raise equity. If the interest rates are low, then debt may be more attractive. So potential changes in the political and regulatory economic environment. This is actually the changes that may happen, especially when we talk about the regulations. Now, again, I also summarized for you all those new issues. So I have summarized here the first class of arguments, and this is actually the second class of arguments. This class of argument is the one which built for us the model, the model of the target capital. This only just additional things you need to consider when you want to raise your capital. With this, I am at the end of this part, and I will see you in part 2. Thank you. Bye-bye.